Good morning, good afternoon, and good evening. I'm Susan Kish, advisor at Sightline Climate, and delighted to welcome you to our very first webinar or Zoominar, Investment Trends 2023. Today, we're going to cover three things. We're going to talk about 2023 highlights. We're going to give a closer look behind some of those highlights, and we'll share a 2024 outlook. If you'd like to see the Clean Tech Investment Trends 2023 report that we're referring to, you can go to sightlineclimate.com, and at the very top of the page, there's a link. Or there's now, I believe, a link in the chat from Oliver. Thank you, Oliver, that can provide that. Please note that's the public report, and the full report is available to clients. We have two speakers who will be walking us through today. Kim So, she's the CEO and co-founder at Sightline Climate, and Mark Taylor, he's the Chief Product Officer and co-founder as well at Sightline Climate. Now, as mentioned, this is our very first webinar, so it may be a little bit bumpy. And I just wanted in advance to ask you for a little bit of patience, and also to ask you to please fill in our feedback form, because we're looking forward to making this better at future events. To get us started, I'd like to ask all of you two questions. And Oliver, if you could pop up the poll, that would be great. Bingo. So first question, in 2024, do you, our audience, think that climate tech funding is going to increase, go to a higher amount, decrease, lower amount, or stay pretty much flat with 2023 levels? Just take a moment, fill this in. And the second question, what do you think is going to be the buzzy topic for 2024? Nuclear, which gets a whole lot of headlines right now, policy, geothermal, the future about the grid, hydrogen, AI and climate, questions of adaptation, or something else. And again, would love your opinion. We'll share the results of the poll at the close of today's presentations. So without further ado, I'd like to ask Kim to present, say a few words about Sightline Climate and to set the stage for today's webinar. Kim.
Awesome. Hello, everyone, and thank you so much for joining our first webinar. Awesome. Hopefully you all can see my screen. It's our first time doing a Zoom one, so we'll see how it goes. But super excited to kick off with everyone today and appreciate you spending your time on Thursday with us for a full hour. So to start, we wanted to give you a quick introduction on Sightline Climate. Many of you may know or read the CTVC newsletter, or have even heard me give a version of this presentation before. So what's different and what's really driving this? So Sightline Climate helps shift from commitments to deployment. When we first started the CTVC newsletter, this was all the way back in 2020, feels like forever ago, when a lot of commitments and early stage startups and venture capital were starting to show signs of interest in the climate tech space. Corporates were making net zero commitments, VCs were starting to fund early stage companies in this space. But over the last few years, we've really started to see this evolution, and many of you have as well, probably, from commitments to deployment, where corporates, investors, governments, banks, a lot of these key stakeholders, both financing and procuring and partnering with solutions in this space, are now starting to think about deployment. And so that's where Sightline Climate comes in. We've built out a deeper market intelligence platform behind the scenes of the CTVC newsletter that's driving a lot of the data, a lot of the analysis that you're going to see today. And all of that really is to answer this question, right, of how do I know what's real? How do I know what's going to be happening in the next 10 to 20 years? And so how do we do that? We do that in three different ways. First is mapping the market to know where to play. For those of you who read the CTVC newsletter, we love our frameworks, we love our market map. So that's the first step, is understanding what does the value chain look like? Who are the key players, both startups as well as corporates that sit within that? The second is tracking the activity. So everything is driven by data. So how do I make sure I'm not missing anything? How do I stay on top of all the deals, the companies, and even now starting to be the projects that are coming to life in the climate tech space? And then finally, it's about finding the inflection to see what's next. So similar to solar and wind a decade or so ago, how do I know when these solutions are going to start to inflect, whether it's on the supply side as well as on the demand side? So those are some of the questions we're looking to solve. And this is how we think about the climate tech space. So we look at it across 4 key climate impacts: monitoring, mitigation, adaptation, and removal. And those climate impacts segment pretty squarely across these 7 verticals. 7 very broad verticals that cover how we power ourselves, energy, how we eat, food and land use, how we move, transportation, industrial, all the materials and goods we make, from steel to cement, built environment, how we live, carbon, actually removing or capturing a lot of the CO2 that we're emitting, and then finally climate management. How do we really monitor and understand the risks and emissions that we're putting forth? And just before we get into the fun part, actually getting into the report and a lot of the takeaways, we wanted to just give a quick word on the methodology. So all this data set, we verified directly with the most active investors. If you're a founder watching this and you're raised around, email us at hello@ctvc.co. We're always trying to track and keep up to date with all the latest deals. We don't include non-public or confidential deals, only include public. And then we focus primarily on private venture and growth investment in this report. And without further ado, I will hand it off to Mark, who will give the 2023 highlights.
Okay. Can you all hear me? Okay, excellent. Sorry about that. So before we kick off, a big part of this webinar is going to be about questions. So please ask questions in the chat and we will moderate them and group them together and have a Q&A session at the end of the presentation. The other part is that the poll is going to end during my spiel here. So if you're a latecomer to the presentation, there's a poll that's ongoing. Please answer the questions. You've got about 10 minutes to do it. So, okay, I'll kick off here just to kind of set the scene. What I'm going to do is explain, from the 40,000-foot view of where we're at in this analysis, and then dig into 2023 a little bit. Then I'll pass it to Kim for a bit more deeper insight into 2023. Okay, so climate tech, really, if you look at this chart, you might have seen it before from RMI or from us. Really, climate tech is on a journey to what we're calling scale. Scale is what's required to meet the challenge of attaining a 1.5 degrees C scenario. And for things to scale, they have to go through a process to get proven out and built and scaled up. You could also call scale, quote unquote, boring, right? Where projects and technologies are repeatable, and the financing is pretty straightforward and bankable and funded by project finance rather than venture and growth. But we're going to focus today mostly on this area here, where the innovations that we're talking about are funded largely by venture and growth funding, and a lot of them are hitting the gap, or quote unquote, the valley of death as well. And so we're going to talk a lot about what's going on here today as companies start to scale up and get into, hopefully, the scale or boring stage. There's a bit of a delay. Okay, so looking all the way back to 2020 in terms of how much funding has gone into this next round of climate tech funding, the total is $142 billion since 2020. And compare that to the $25 billion that's gone into Clean Tech 1.0 from 2006 to 2011. It seems like things are quite a bit more serious now, bigger deal, and a bit more intent on getting this right and getting this done. You can compare, just 2020 alone was 19.7 billion compared to all of 25 billion in Clean Tech 1.0. And the thing to note about this chart here is that this is the total deals and total investment. It's going up, but it's tapering off ever so slightly in the past year and change. And so we'll get into that a bit more. Okay, but looking at the ecosystem itself, the ecosystem is robust. The state of the union is strong. 2,600 companies took shots on goal or were founded as climate tech companies in the past 4 years. And if you look across those companies, they're mostly in most of these sectors that we cover. But if you look at investment, it's a bit of a different story. So 80% of the investment is in three of these sectors. Sorry, the slide jumped around a bit. Largely in what we're calling the big three: transportation, energy, food, and land use are what we're calling the big three. And the other verticals that we cover are industry, climate management, built environment, and carbon. And we also track these by sector and technology so we can really understand what's going on at the base level in all of these climate tech verticals. And looking at investment, historically, the biggest have been in food, in alternative protein, and batteries and autos, making up roughly 39% of investment over this time period. Okay. And how does this correlate to emissions? So all this investment gone into climate tech, how does that go into tackling the problem of global emissions? So we compared that to investment in, emissions from the IPCC report in 2019, and you can see this chart here. And so on the right side, you'll see global emissions and going down from energy, industry, food and land use, transportation, built environment, matched against the investment that's gone into that sector. And you can start to see a couple things: that transportation, it might be overinvested in terms of its match up to the 15% of global emissions. Energy, industry might be underinvested compared to their contribution to global emissions. And why is this? This could be because transportation, when climate tech was re-kicking up back in 2019, 2020, you had generalist investors coming over and doing things they understand: cars, charging networks, seeing the success of Tesla and others, and trying to replicate those successes. But then you have other things like industry, which were, relatively hard to understand, early stage technologies, and the high cost of switching out existing and industry infrastructure. But what we're starting to see is that's starting to shift, and we'll talk a lot about that in this session. So, okay, now that we've set the scene a bit for how we're doing, how things are as a whole in climate tech investment, we're going to dig into 2023. So we're going to go through a few charts here, but if you remember just three things, they're these. Number one is that investment was down 30% from 2022. Number two is that growth investment was the most down, but the market freeze also came for the early stage this time in 2023. And finally, deals got done, but they were just smaller. And we'll go into some of the whys in this presentation. Okay, so this is the 2023 chart. This is the quarterly investment in climate tech as a whole. The bars represent quarterly investment. The line represents the number of deals. A few things to note about this. Number one is that the total investment is down. It totaled $32 billion in 2023, down 30% from 2022. The deal count, despite the drop off in H2 or the second half of 2023, it was relatively flat. It didn't go down too much. And you'll also notice that there's been a peak in Q3. This peak has carried on historically. Every year, Q3 seems like the hot quarter to get things done. Maybe it's people getting things done before they close out for the new year, for the end of the year, but Q3 is always the big one. And there's been a downtick, and how does that compare to the wider market? We said climate tech is down 30%, but the wider market in venture, from preliminary reports from other organizations, seems like it's down 39%. So it's in the ballpark, but maybe not quite as bad. The other thing to note here is that 2021 and 22 were the frenzy, the peak. And 2023, you could say, okay, it's down. You could also say it's a reversion to the norm, right? Things are getting back to normal. There's less of a fuss, and now things are being a bit more measured in how people are going about things. Okay, so you notice the spike in Q3, and we'll look at why that is. It was because of several mega deals that popped up in Q3 that were really to get companies over the gap, over the valley of death and into that scale era or phase. The top 10 climate deals made up more than 30% of the total investment last year. And those were largely in transportation, industry, and energy. Now, there's three themes that we'll note about this investment in Q3, in these mega deals. Number one is that these projects or big investments that came in were largely for projects that were already in motion. The climate or the macro environment in 2023, as was not all that easy. It was roughly, it was challenging. And so nobody was really saying, like, you know what, I'm going to do $1 billion project this year. These projects were largely kicked up in previous years, and the financing that came in were to get them over the line and get going. The next thing is that they're mostly batteries. A lot of these, you'll see a lot of these companies or battery companies distributed regionally across the world. It seems like each region has their marquee battery company. And so there was quite a bit of battery investment last year that made up the bulk of the large deals. And finally, that governments played a big role. For four of these deals, at least, there was a big government catalytic funding round that preceded this private round that really gave it the muscle or the juice to get this project or to get these companies moving and get their projects over the line. Okay, so digging quickly into the trends for 2023, this is what you'll see a lot of these charts in our presentation. These are bar charts showing yearly investment or yearly figures for climate tech. This one shows investment, right? And so this one shows investment by stage. The first thing you'll note here is that investment in growth rounds really dropped off last year. Previously, growth rounds accounted for 50% of investment. Now in 2023, it was just 39%, so quite a bit of a drop. The other thing to note on this chart is that Series A dropped for the first time. It could be because companies or, investors are being much more measured and looking for milestones in terms of their investments. So everything's tied to milestones and success or solid business models of companies. And so investors could be taking a more cautious or measured approach to their investments. Next is deal count. So seed and Series A deal activity tapered, sure, definitely. But you can also see there's drops in all the other stages as well, especially growth. Next is that, you take fewer deals and you couple that with lower round size, as you can see in this chart, and you get the recipe for total investment that goes down. And so what you can see from this downsized round, you see a downsized rounds in growth, but also in Series A as well. Some notable exceptions, Series C was actually up. There were some larger deals that happened in Series C in 2023 that were contributing to that being up. Okay, and then the next thing to note is that we're looking at this by sector now, or by vertical. There's two things that are really important to note here. One is that food and land use, something that was part of the big three that really took a lot of attention in the past, really just dropped off in investment in 2023. People, I guess, lost their taste or lost their appetite for alternative proteins and other things in food and land use. The other is that industry really popped up. Why is this? As we said, like maybe it took investors time to get used to sectors they might not have been interested in or acquainted with. But industry is really quite hot right now and is moving up and up in basically all categories. And again, transportation is down and industry is down as well. Okay, and deal activity was still high, and it was even up for some verticals. We just mentioned industry was up, as well as built environment and carbon. Built environment was largely due to HVAC deals and energy efficiency deals. And so the deal activity, as you said, was down a little bit, but on the whole, it wasn't down very much at all. Okay, and then finally, deals got done. They were just smaller. So in every sector, there were deals that were done last year, but they really just were smaller. And as you can kind of see, it's kind of a reversion to the norm, as we said, that in built environment, you had a peak in 22, same with climate management and carbon, and in other sectors, it's on kind of slide, like food and land use is down quite a bit. So that's a quick look at 2023 and the broader picture. And I'm going to pass it to Kim now to go into more detail on what happened in 2023 and what's going on in 2024. Kim, over to you.
All right, thanks, Mark. Many of you might have heard the word down a few times in those 2023 highlights, but down does not necessarily mean out. So 2023, if you can remember three things, we're going to dive a bit more into the trends that were driving the activity in 23. Number one, 23 was a wait and see year in many ways for big investments, both for investors as well as founders looking to raise. The second is that companies weren't graduating, and we'll define what graduating means, but companies were not graduating. And the third is exits were fewer and far between compared to prior years, especially in SPACs. And a little bonus taste, but investors, as we noted, have seemed to lose their taste for alternative protein. All right, so wait and see. Here we focused a bit closer into the $100 to $500 million deal cohort. And why did we focus in this one? It's because in many ways, this is the, call it Series B plus stage, where companies are raising larger rounds to finance first of a kind or large demonstration, first commercial scale facilities. So this is an important one to note because this is really the type of financing that fills that funding gap we noted at the beginning. Previously, this cohort has made up 50% of total investment every year. This year, it's made up 30%. So you can see that drop off both in terms of investment as well as deal count. And there were a few reasons for this. One was we were still waiting and seeing in many ways on how policy was shaking out. So Inflation Reduction Act, landmark climate legislation in 2022, took a while for those tax credits to get solidified. So we're waiting on hydrogen, we're waiting on the domestic manufacturing credit, on SAFs. Same thing with legislation in Europe as well. And then also same thing with interest rates. We were waiting to see what would really happen with interest rates, if it would continue rising and make it harder and more expensive for projects to get done. And now there seems like clear signs to those declining. So this was the reason for a bit of a wait and see and caution in a fall in these mega deals. Now, graduation rates. So before I jump into this, what are graduation rates? Graduation rates define the count of companies that were able to graduate to the next stage. In other words, whether a company was able to move from seed to Series A to Series B, so on and so forth. And this is important because it's a marker for investment health, right? You can have a lot of investment coming into a space, but understanding whether companies are graduating or not tells a story on whether or not companies are really starting to hit their milestones and get validated by investors to reach that next stage. And what we see here is that graduation rates were at all-time highs in the first half of 2022, in many ways kind of the tail end of the peak, right? So 30% of companies in that first half of 2022 were able to graduate to the next stage. Fast forward to the past 6 months, only 20% of companies were able to graduate to the next stage. And so what that means is many companies were either extending their existing rounds, raising bridge rounds, or it was new companies, maybe early stage seed companies that were financing brand new rounds. And so this continues to tell that story of wait and see, extending runway. Many founders are worried about repricing in a potentially down market. Many markets were also oversaturated, so it made it harder to hit certain benchmarks, especially at the later stages. And then overall, it was just tighter funding conditions, right? So harder to kind of graduate to the next stage. And we can see this across all stages. So graduation rates declined across all stages, particularly hardest hit in the Series B to C and C to growth stages, especially because benchmarks, milestones get much harder and higher when you're at a later stage. And if we zoom in on specific sectors, who are the sector dropouts who didn't graduate? These ones particularly pointed to some of those sectors that drew down food and land use. Crop yields, indoor farming, alternative protein saw all pretty big drop-off rates. And then another one, emissions reporting, where we've categorized a lot of the carbon accounting, ESG reporting, also had a pretty significant decline in graduation rates or dropouts. And that's particularly because many of them had graduated in prior years, and there seemed to have been a decline in how many were able to get to the next stage, at least in 2023. Now, turning our attention to exits. We looked closely at exits over the last 4 years. In particular, it's notable that exits almost dropped off 50%, almost 50% this year. And a lot of that was driven by the closing of public markets this past year. So not just climate tech, everywhere across the board, but in particular, especially in climate tech, we saw the almost death of the SPAC market. So SPACs were down 90% compared to 2022. Probably not a surprise to most, but SPACs were definitely a big driver of the climate tech space. Lots of battery, aviation sort of companies SPACing and going public that way. There still continued to be a healthy amount of M&A and acquisition activity. However, 80% of those acquisitions were undisclosed. And when you don't want to say something, it probably means you're not super proud of it. So one way to read that could be a lot of those acquisitions were smaller or tuck-in acquisitions, where larger companies tend to acquire smaller companies and absorb them. And it might be at lower exit valuation. So still a good outcome, but not a great outcome. And in particular, here were some notable acquisitions in 2023 on the spectrum of great to good to maybe not so good. So the first one was carbon engineering. I think many people in the climate tech space, when they heard about this, dropped their phones or whatever when they saw the notification. This was Oxy acquiring carbon engineering for $1.1 billion. So our first unicorn exit in carbon removal. And the rationale driving this was really a strategic one. So Oxy acquired carbon engineering. They were partnered together on a direct air capture technology. Carbon engineering was supplying the technology to Oxy. And now Oxy's acquisition signals their plan to build 100 DAC plants by 2035. On the other hand, there's Volta, which was acquired by Shell. Volta was one of the companies that SPACed, an EV charging company. They SPACed at a $2 billion valuation and were as a result ended up in the SPAC attack, I guess, so to speak, and fell out of the public markets and ended up acquired by Shell for $169 million. So pretty big drop off to the valuation at which they SPACed. And then there's the other example. British Bolt was a British battery business. They filed for administration and then were acquired by Recharge for $11 million. So again, these kind of run the gamut of great to not so great. So acquisitions can not only spell, great outcomes, but can sometimes also mean, tuck in smaller acquisitions. Of those acquisitions, corporates have been the most active. Surprise, surprise. Primarily because of energy companies, such as oil and gas companies, that have been scooping up earlier stage companies as they scale their energy and climate transition goals. We also see other types of corporates and acquirers as well. So other, energy companies like Schneider, we see private equity companies like Brookfield as well playing in these spaces. And then the little bonus taste. So we keep hammering on all these food and land use puns, but investors did plant fewer seeds or lose their appetite in food and land use. So in the past, even as recent as last year or as recent as 2022, food and land use has been the sector where most investors have participated in climate tech. It's a vertical, people can understand, everyone eats food. However, this year, for the first time, food and land use investors were not as appetized by food and land use. So investors participating in food and land use dropped to 258 relative to 369 in 2022. And in fact, industry, surprise, surprise, took its place. So industry now is the third place vertical in which investors were actively participating. So food is out, maybe industry is in. So that's a closer look at some of the trends that were driving 2023, but we want to take those trends and understand what might hold for 2024. So here are the 3 things and a bonus for you to remember for the 2024 outlook. Number 1 is survival of the fittest. Early stage venture startups, it's all about survival of the fittest. This year, we think we'll start to see that play out. The second is sophisticating climate capital stack. So for those who do, survive or are fit and stay in the race, there is a sophisticating climate capital stack to finance those companies over the gap. Finally, we think there will be an end of wait and see, and we'll hopefully see how you all think about that as well from the poll. And then finally, a bonus, TBD, but it seems like 24 might be the year of energy. So first one, survival of the fittest. We see that survival of the fittest is starting to play out in maturing sectors. So, climate tech in its current iteration kicked off probably in the 2019-2020 period. Of that time frame, autos, indoor farming, micromobility seems to have been around the longest, has been the most mature. And we're starting to see a couple companies, drop out of the race, so to speak. So there were 7, 6, 5 companies that we tracked that either went out of business or went bankrupt in those 3 more mature sectors. And as these other sectors mature, naturally, there will be a flight to quality, right? So flight to quality for the select winners in these spaces, and ones that don't necessarily make it, dropping out of the race or getting acquired by other companies. And that's natural, that's inherent in this cycle. So we should continue to expect that, especially as the broader climate tech space matures. However, for the companies that do stay in the race, that do make it and survive, there is a sophisticated climate capital stack that we think will really help finance and fund solutions, especially hard tech solutions across that gap. And so here we've been closely tracking the investor landscape to finance climate tech. We started off with the running list of VCs all the way back in 2020. So you can go on our site and see the climate capital stack. That list ballooned from 50 VCs in like 2020 all the way to more than 300, and probably more than that now, that are actively financing climate tech, that are specifically allocating their funds to climate tech. However, as the entire sector has started to shift from early stage innovation to deployment, we're also seeing the capital stack sophisticate or evolve to adopt to that growth. So more growth in private equity players such as Just Climate, Generation, General Atlantic, TPG, et cetera, et cetera. And then notably, we're seeing more in this, what we call emerging/growth infrastructure space. Another way to read this is project finance, infrastructure investors that are more willing to finance that first of a kind or funding gap ecosystem. And so of those, we've noted a couple new funds that have emerged, such as Breakthrough Energy's Catalyst Fund, Builder's Vision, that are specifically looking to fill that financing gap and help finance that, 100 up to 100 to maybe $500 million deal cohort. And of course, there's always strategics and corporates who can play across all of these different stages, from early stage capital all the way to financing and piloting with some of those first of a kind and emerging projects. And one thing to think about here too, which is I think something that is underemphasized in the climate tech space, is that the absolute dollar of venture and growth in climate tech does not necessarily spell the success of the overall category in of itself. For those who recall, Clean Tech 1.0 was not necessarily a huge success for the venture investors, but in many ways was a huge success for the 2 most important technologies that are driving the energy transition, solar and wind. And we'll continue to see this evolution, right? Where companies and solutions within the climate transition will also start to graduate beyond venture, beyond growth, to having their solutions, their technologies financed in projects from providers like project finance investors, banks providing loans and debt, and of course, government as that critical infrastructure that's really enabling it. So that's one thing to keep in mind, is that despite the overall venture and growth market being down in climate tech in 23, that there's signs of this evolving capital stack trying to finance technologies across the gap. And then finally, we think that, C2VC readers think that investment in 2024 will bounce back. So we did an Oracle survey. We called it the 2024 Oracle survey, and we had C2VC newsletter readers respond to it. And one of the questions was, will climate tech investment increase in 2024? For those, 90% of the survey respondents answered yes. They think that 2024 will bounce back. So in many ways, it seems like an end of the wait and see, that valuations, which seem to be still a little bit high maybe in 23, are starting to come down back to the expectations, that founders who held off in 2023 because they were waiting and seeing to see what the market fallout would look like, are all actively looking to raise. We've been closely talking to climate founders and investors in this space. And many founders we talked to are planning to, if not thinking about fundraising in 2024. Even investors are pretty excited about the start. We spoke to one investor this morning who said they're excited. Deal activity seems to be back on. It's been a good start to the year. So seems like an end of the wait and see period as well, at least from survey respondents. And in this 2024 Oracle survey, we also asked another question, a question that we asked you all at the beginning of the poll, which is, what do you think the buzziest topic for 2024 is going to look like? And buzzy can mean a few different things, right? It could be, hot air balloon to lots of funding to, hey, this thing's really going to make a dent in the mission. So we looked at the buzzy topics by vertical. We took all your buzzy topics from the survey we sent out to newsletter readers, and we categorized it based off of the vertical. So that's the teal bar on the left. The pink bar on the right was comparing it to the percent of investment in 2023 by those verticals. So you can start to see how those buzzy topics stacked up to investment in 2023. In 2023, continuing with trends, transportation, what made up the largest portion of investment, 33%. But if we believe this survey is a leading indicator of what's to come in 2024, 49% of respondents had a buzzy topic that fell within the energy vertical. So seems like 2024 might be the year of energy. And finally, if we zoom in a little bit to those buzzy topics, what made those up? We start to see a little bit of a trend where nuclear, policy, geothermal, grid, hydrogen, AI, and climate adaptation top the charts. And in particular, saw an underlying theme in baseload and flexible solutions for energy. So nuclear, geothermal, grid, hydrogen. And maybe it's Oppenheimer. I think they've gotten, 13 Oscar nominations, but nuclear seems to be in for 2024. So we'll see what shape and form that takes. But that concludes our 2023 takeaways report and 2024 outlook. Thank you so much for listening to us and for sitting here while we share our insights for the year and what's to come. And I hand it off to Susan.
Thank you. And I'm going to ask Kim if you can stay there and stay on screen. And also Mark, if you can join us. And let's take this slide off just so that we can take a look at the three of us. So we got a great number of questions in the audience. So thank you all very much for taking the time. Some of them we were able to answer. Oliver sort of responded to them during the course of the conversation. And some of them we're going to talk through in the next few minutes. So Kim, I'm going to start with you. One of the questions that came up was digging a little deeper, just in terms of what you're seeing for buzzy topics, which is, are there any particular subsectors in these that you're seeing, you think that might have some really interesting momentum month on month or year on year that you think are, could be areas to really take a hard look at? So it's one level down is really what they're looking for.
For forward-looking?
Yes. Well, no, for buzzy topics, looking forward, yes.
Yeah. So, I mean, I think our respondents had a pretty concentrated response to what they think the buzzy topics for 2024. Our research team is focused on nuclear, geothermal, hydrogen, and in particular, it seems like there's been a resurgence in nuclear. Last week, we published a headline in CTBC about uranium prices, which are at 16-year highs, $106 per pound. And I think that's both a leading and a lagging indicator, right, of the demand that's coming in, but also the supply shortages that have been kind of lagging. So I think I agree there with the broader ecosystem. In terms of other buzzy topics that we've been looking at and tracking, we're particularly looking at areas in industrial decarbonization. So we've seen that, mismatch of emissions, industry now seems to be kind of veering back into investors, interest areas. So particularly in steel, cement, decarbonization, where they're both each making up 8 to 9% of emissions, seeing a lot of opportunities where carbon credits can even be a little bit of a boost, so to speak, for revenues for those companies. So that'll be an interesting thing to watch. In addition to CBAM in Europe starting to drive a lot of need to decarbonize in these industries.
And CBAM is the cross-border adjustment mechanism, just
Correct.
For a broader audience. And actually, maybe this is a good chance for Oliver to share those poll results and see what the greater group thought of as the buzzy topic.
I'm very curious about this. How did it stack up?
Well, there's a lot of interest in AI and climate, number one at 32, grid at 20, nuclear, nuclear is in the top tier, but it's down at 13%. So interesting. It's a different sort of filter than we've got before. And Mark, I'm sorry, geothermal's only at 3.
Susan says that because I studied a lot of geothermal many, many, many years ago. And once a fan, always a fan. But I think one thing I would say also about buzzy topics is that we get a lot of inbound from our clients. And two things we pretty consistently get asked about is SAFs, or sustainable aviation fuels, and grid tech, both grid tech hardware and software. I guess, it really falls into the notion that grid has largely been underinvested, and there's a lot of opportunity to improve it in order to accommodate all the flexible capacity that's coming in. And so left and right, we get asked about those topics.
Got it. And actually, if you look at that first question with 70% increase for climate tech funding, that pretty much aligns, right, Kim, with the numbers you saw broadly?
Yeah. We saw 89%, so slightly lower, but still very much in the majority.
Exactly. Actually, this is an interesting, one of the early questions we got here was how these climate tech trends parallel or are different from sort of general technology trends, right? Do you see these being aligned? And that's not only in terms of trends, but it's also in terms of things like, the hot areas of AI or oil and gas or fintech, right? What are the correlations or patterns that you see across? Mark, do you want to take a first stab at that one?
Sure. I mean, it's all comes back to corporate strategy, right? What they need. So I would say kind of two things, and I know everybody on the audience is going to have a differing opinion and all this. This is just my opinion. That oil and gas companies, sure, they need ways to diversify, right? Oil is pretty strong at the moment, but they're looking for ways up and down the value chain for obvious and not obvious ways to compete and sell to their customers. So you could say, okay, if you're looking at EVs, you could say, well, I'm going to start a car company, but no, I started an EV charging company, but no, there could be more opportunities up in the mining area or in the distribution area. So that's one thing. The other thing is, what does AI even mean for this? For some, it could be coming up with new materials. Like we saw the announcement last week of the new battery materials that are stable at room temperature, et cetera. Fantastic, amazing stuff. But at the same time, it could mean more power demand from running all those queries that we're constantly running now with ChatGPT and the like. And so it could be more energy or low carbon energy flowing into powering data centers and the like.
Excellent.
So it all comes back to what the company needs.
Got it. One of the other questions, and this has to do with where the exits are in graduation rates, was, can you speak, and this came in from Ted Orban, can you speak to the trend of oil and gas companies acquiring climate tech companies in 23 and how it might play out in 24? In other words, do you continue to see them as the major player and be even more active going forward? Kim, do you want to start that one?
Sure. Well, this was actually another question we had in our survey that we asked our readers, and it actually ended up pretty 50-50. So the question was, will oil and gas be the largest acquirer in 2024? A couple thoughts here. The first one is that when you look at the historical trend of oil and gas acquisitions in climate tech, many seem to follow one after the other. So in the early 2020s, we saw a lot of acquisitions for EV charging. Green, I think it was like GreenCom and many of these EV charging networks were acquired by oil and gas companies when they were trying to make their play for EV charging. Recently, there's been a lot of acquisitions in RNG space. So you start to see these trends, right, in oil and gas for what's going to be an area they can expand their business into that's either adjacent or directly, downstream of their existing businesses. This year, I think there's a lot of interest and activity in oil and gas, in climate tech sectors where oil and gas skill sets can be particularly relevant. So think geothermal. Fervo had their big breakthrough enhanced geothermal system, which uses a horizontal drilling method similar to fracking. You have hydrogen, right, which is molecules, oil and gas companies very, very used to not only producing, but also transporting those types of molecules. So I think, in my opinion, there's a lot of opportunity in climate tech where there's a lot of parallels to the types of skill sets and the types of talent needed to scale these climate tech solutions. Even if you zoom into Houston as an example, I went to Houston twice actually in 2022, and they're really building out their climate tech ecosystem. They have an accelerator now focused on climate. A lot of climate tech companies like Syzygy have chosen to start and build their company in Houston because of all of the natural, talent and partners that are available. So I do think there will start to be a lot of more intersection between oil and gas coming into climate tech.
Thank you. One of the other questions that's related has to do with not just the acquiring, but the role of corporate VCs and the role of those kind of strategic investors in these rounds. Is that a trend you see? And there is data that shows CVC actual initiatives are many people are closing it, but at the same time, you see data that's just the opposite. Mark, can you speak to that, to the role of CVCs in this sophisticating climate stack and going forward?
I mean, it feels the opposite to me. We talked to a lot of CVCs that are trying to figure out what is the new thing for their company to latch onto, and they're very, very active and very smart, and they're asking all the right questions about where they should be operating. And it all comes back to, I'm a broken record here, but it all comes back to what are the core competencies of the company, as Kim was saying, and how can they find a company or find a suite of technologies to enhance what they've got in-house. And so lately, I feel like I've seen nothing but, enhancements or buildups of CVCs instead of closing down.
Got it. One of the questions that comes up several times here in the Q&A has to do with FOAC, that lovely analogy, first of a kind, right? And also this general question of how do you get over that gap to really get to massive commercialization. So can you also speak to this question of, is this a technology de-risk question? Is this a availability of capital and the right investors? Is this just a matter of patience and time? What's preventing us from getting over that hump to where you, as you said, you see now solar and wind, they feel like they've broken through that barrier. How do we get other technologies across that Rubicon?
Yeah, I can kick off with this, and Mark would be curious. Obviously, you were covering this space during that initial wave, so you should definitely speak to your experience there. I'd say it's three main points. The first is it all comes down to risk and return, right? You always want to have a bit of a parallel, a bit of a proportional risk to return ratio. And in the early stage, why venture investors are venture investors, it's because there's high risk. Many of these companies fail, and that's just how it works. But there's high return. You can make 10 to 20x. Then all the way on the other side of the spectrum, where traditional project finance, where banks play, it's a much, much different risk return story. It's lower risk, lower return. So you expect cash flows. You do not expect a project to fail. And I think first of a kind, the nature of first of a kind is that it's the first of a kind, FOAC. It's a made up word, but it's the first. And so the nature of first of a kind means that it has never been done before, which is risky. And if it's a project, the nature of that project typically too is that you don't typically see the 10x or 20x inflection points, because the way you make money off a project is the cash flows, right? So you get an offtake agreement, they pay you money, you make money off the cash flows. So that proportion is a little bit skewed for a lot of these first of a kind projects. And I'd also say the second point, right, is the question of technology risk level versus project risk level. And those are two slightly different things. Technology risk level, TRL, so for those who know the TRL scale, it's 1 to 9, is started by NASA. And 1 means it's super risky, 9 means it's mature. But once you get to projects world, having any sort of TRL, even if it's like a tiny bit of technology risk, is non-negotiable for project finance for banks that are lending capital. So that's why it's a bit of a tricky situation as well, because not only does your technology have to be mature, but you also still have project risk, which is no one's built a project using this technology before. So even companies like Northvolt or H2 Green Steel, H2 Green Steel is a great example of this. One could argue that their technology is all mature. They're using off-the-shelf technologies for hydrogen, for the steelmaking. But that project has never been done before. No one's ever put these pieces together. So it's still first of a kind. And that's why it's also naturally challenging, because it's not just the technology risk element, it's also the project risk element. And then finally, the third point is that there's a lot of external factors at play here. So we've written about this a few times in the CTVC newsletter. We think of this as having a bankability checklist. So bankability means that a bank is willing to finance you. It means you've kind of gotten to that boring stage, right? Or that scale stage. And in order to fill that bankability checklist, there are a few prerequisites, but probably the most important prerequisite is having offtake, or having someone who is saying, yes, I will buy the output from your project. Exactly.
Right.
Someone will buy the output from your project, and not just, I'll buy it one off, but be able to fill that overall output production capacity, and be able to do that ideally for 5 to 7 years, because it all comes back to de-risking, right? De-risking those cash flows. And so for power, what's been nice is that you have 5 to 7 year PPAs, you have long-term offtakes. That's just the nature of this industry. But for other industries like industry, right? For steel or cement, or even, food to a certain extent, these are commoditized industries where there are not 5 to 7 year offtakes don't exist. People buy off the spot markets. And so if you're bringing a new technology to market and you're building a new project that costs a lot of capital, it's really hard to get these 5 to 7 year offtakes, because the industry is just not used to buying it that way. And so it's this chicken and egg cycle, right? You can't get the offtake, so then you can't get financing, so then you can't build your project. Now, all that being said, and I'm sorry I'm going on such a long soliloquy, all that being said, there are de-risking and mitigating factors to this. I mean, government funding, loan programs office, the European Investment Bank are all examples where they're trying to stop gap, or they're trying to catalyze really those funding gaps so that private market investors and lenders might come in. So I'll stop there, but there's always more to talk about on that topic.
And we had a couple follow-up questions. Brian Collins asked about, how does this specifically impact a technology like DAC, right? Direct air capture, right? As we try to get those projects mature, even with the Oxy purchase last year. But it feels like the answers to that are embedded in what you just talked about, Kim. Is that right?
Yeah, so carbon removal is an interesting example where I actually think out of a lot of and maybe this is, no, I think this isn't that hot of a take. I actually think carbon removal out of a lot of these emerging climate technologies has done a really good job of solving for this offtake challenge. So carbon removal people, they're some of the most, they love to form coalitions, they love to form communities. And I think there's been a lot of good effort to solve that chicken and egg problem through advanced market commitments. So what we started to see, probably I think in 2020, Stripe had launched their initial carbon removal fund, not to just invest in the startups, but to actually serve as a buyer for these projects, serve as a buyer for the credits coming from these projects, because these technologies were still early. And particularly for direct air capture, what's people can argue over direct air capture and the necessity of it, but at the end of the day, if we think carbon removal needs to exist, direct air capture is nice in the way that it's permanent, it's durable. So if you're thinking about the overall voluntary carbon market and the flight to quality, you're a corporate, you want to get to net zero, you want to buy carbon credits. It's better now to go after higher quality, more durable credits. And so I think carbon removal has done a good job of creating these types of longer offtakes, and the declining quality, I think, in the voluntary carbon markets is really driving these corporate buyers to consider, hey, maybe instead of just buying $3 to $5 credits where they might not exist or they might not actually do what they're supposed to be doing, we should be going after higher quality credits that are permanent, that are durable, and paying up, right? It could be hundreds of dollars per ton, if not more, but knowing that we're buying stuff that's more durable. And so that's what we're seeing in direct air capture and carbon removal at large. So like Climeworks, Charm, a handful of these have done a really good job of building out those long-term offtakes to finance their plants. Like Climeworks has now one commercial plant, Orca, and another one in the works, Mammoth.
Excellent. Mark, I want to forward you a question that Akshatha Bhatt asked about graduation rates. And it's really a question around the data that, it could be that the decline in graduation rates you're seeing in the data reflects the fact that your focus is on VCs and growth and those sources of capital, as opposed to some of the other sources of funding like project finance. And it also brings up this broader question of where do you see the role of credit and debt financing in this increasingly sophisticated capital stack?
Yeah, great question. And there's a lot of ways I could take this answer, but the short of it, I'll do it in a few parts. One is that, and I realize we have short on time. One is that the early stage funding for these projects is typically not going to come from project finance because of TRL, as Kim mentioned. Two is that the venture capital and growth funding is not something you necessarily want around forever for a given sector. You want it to graduate to debt and credit and project finance writ large, so that it's can scale and get done. Like, how often do we talk about VC for wind and solar these days? Not too much. And the third thing I would say is that I've been around for a long time. You can see I'm kind of losing my hair. Back in Cleantech 1.0, I was tracking CCS projects and all these announcements that would say, hey, we're going to build 5 of these projects. We're going to build 10 of these projects. And I kept saying, well, somebody show me one. And so we built this model that tracked these projects getting done, getting over the gap. And without fail, every single one of them was funded with public dollars, and some corporate, contribution
Really
to those
point.
public dollars. And so, yeah, it's not just as simple as saying, okay, debt's coming in, it's going to happen right now. None of these things are a given. Everything needs a carrot and or a stick to get done. I think as Kim was kind of mentioning here, that they need somebody to buy it, and they need somebody to force the issue. And so I know I'm baking a lot into that answer, but really what good looks like here is that these technologies graduate, the ones that make sense, that graduate to using project finance and debt to get these projects done. But it's not necessarily a shortcoming of data collection. It's more a shortcoming of this is where these sectors are right now, if that makes sense.
Absolutely. Well, listen, I'd like to thank both of you for your questions, and thank both of you for a great presentation. I looked at these materials before, but I learned something every single time. We're conscious of everyone's time on the call, so I'm going to bring the questions to a close. There are a lot of things that came up, and we'll take a look at these questions, and when we do the write-up, we'll do our best to respond to many of them. I'd like to thank everyone for joining us today at the Sightline Climate. As you might remember, we had 3 takeaways from each of our 3 sessions. For 2023 highlights, down by 30%, especially in growth and also in early stage, and deals got done, they were just smaller. In our closer look, we looked at that last year was really a wait and see year. Things weren't really graduating, and Mark just talked to this, and exits were few and far between. And for 2024, I think there's a bit of optimism. Survival of the fittest is really this time. A sophistication in terms of the capital stack, and the end of the wait and see. And hopefully this will be the year of energy. So great takeaways. Thank you both very much. We'll be sending out a link with the feedback form. As we said, this is our first webinar. So please take just a couple minutes and provide some suggestions, areas we can improve. We'd love to come back to you with another webinar and hopefully be even better the second time. If you'd like to listen to this podcast webinar later, we will be posting a link on cdvc.co and also on sightlineclimate.com. If you have more questions or you want to learn more about Sightline Climate and become a client, send a note to hello@sightline.co or visit ctvc.co, where there's a really, really discreet line at the very tippy top of the page to ask for a demo. I'd like to give special thanks to everyone today for joining us, and have a wonderful afternoon, a morning, or evening. Thank you.